Section 5:1 Implementation and Execution. 5.1 Investment Vehicles for Sector Rotation. When implementing a sector rotation strategy, there are several investment vehicles suitable for gaining exposure to specific sectors. Here are some common options. Sector-specific exchange-traded funds, ETFs. Sector-specific ETFs are designed to track the performance of a particular sector or industry. They provide diversification within the sector and allow investors to gain exposure to a specific industry without having to select individual stocks. Sector ETFs are listed on stock exchanges and trade like stocks, providing liquidity and transparency. Sector-specific mutual funds that focus on specific sectors or industries are another option. These funds pool investors' money and are managed by professional fund managers who actively select and manage a portfolio of securities within the targeted sector. Sector mutual funds can provide diversification and professional expertise but may have higher expense ratios compared to ETFs. Index funds. Index funds replicate the performance of a specific index, such as a sector index like the SP 500 Information Technology Index. By investing in index funds, you gain exposure to the overall performance of a sector without the need for active management. Index funds generally have lower expense ratios compared to actively managed funds. Sector-specific stocks. Investing directly in individual stocks of companies within targeted sectors is another approach for sector rotation. This requires conducting fundamental analysis and selecting stocks based on their financial health, growth prospects, and industry position. It can provide the opportunity for higher returns but also carries higher risks compared to diversified funds. Sector-specific options. Options contracts can be used to gain exposure to specific sectors or hedge existing positions. Investors can use call or put options on sector-specific ETFs or stocks to implement various strategies, such as directional bets or hedging against downside risk. Options trading requires a good understanding of options mechanics and carries additional risks. Sector-specific closed-end funds. Closed-end funds are similar to mutual funds but trade on exchanges like stocks. They have a fixed number of shares and can trade at a premium or discount to their net asset value, NAV. Some closed-end funds focus on specific sectors, providing exposure to a targeted industry or sector. When selecting investment vehicles for sector rotation, consider factors such as expense ratios, liquidity, tracking error. For ETFs, historical performance, fund manager expertise, and the investment horizon. It's important to conduct thorough research and understand the risks associated with each investment vehicle. Additionally, consider diversifying your sector exposure across multiple investment vehicles to spread risk and capture potential opportunities within the sector rotation strategy. When executing sector rotation strategies, different investment vehicles have their own advantages and disadvantages. Here's an evaluation of some common investment vehicles used in sector rotation. Sector-specific ETFs. Advantages. Diversification. Sector-specific ETFs provide instant diversification within the targeted sector by investing in a basket of securities. Liquidity. ETFs trade on stock exchanges like individual stocks, offering liquidity and the ability to buy or sell throughout the trading day. Transparency. ETFs disclose their holdings daily, allowing investors to know exactly which securities they hold. Lower costs. ETFs generally have lower expense ratios compared to actively managed funds, which can be cost-effective for long-term investors. Disadvantages. Tracking error. Some ETFs may not perfectly track their underlying sector index, leading to tracking error and potential deviation from the sector's performance. Limited flexibility. ETFs typically follow predefined rules and may not adapt to changing market conditions or adjust quickly to new sector trends. Overlap. Different sector ETFs may have overlapping holdings, leading to potential concentration risk if investors are not careful in diversifying their portfolio. Sector-specific mutual funds. Advantages. Professional management. Mutual funds are managed by professional fund managers who analyze sector trends and make investment decisions. Active strategy. Mutual funds can actively adjust their sector allocations based on market conditions and their outlook, potentially capturing opportunities. Research support. Mutual fund managers have access to research and resources to support their investment decisions within the sector. Disadvantages. Higher costs. Mutual funds often have higher expense ratios compared to ETFs, which can eat into returns over the long term. potential underperformance. Actively managed mutual funds may not consistently outperform their benchmark, and fund manager expertise can vary. Redemption fees. Some mutual funds may have redemption fees if investors sell their shares within a certain period, which can limit liquidity. Index funds. Advantages. Broad market exposure. Index funds provide exposure to the overall performance of a specific sector, tracking a market index. Lower costs. Index funds generally have lower expense ratios compared to actively managed funds, as they aim to replicate the performance of an index rather than relying on active management. Passive approach. Index funds offer a passive investment approach, which can be appealing to investors who prefer a more hands-off strategy. Disadvantages. Lack of flexibility. Index funds are designed to replicate the performance of an index and may not be able to adapt to changing market conditions or adjust sector allocations. Limited potential for outperformance. Index funds aim to match the performance of their benchmark index, so they may not generate significant outperformance. Sector-specific stocks. Advantages. Selective exposure. Investing in individual stocks allows for more selective exposure to specific companies within the targeted sector. Potential for higher returns. Successful stock selection can lead to higher returns compared to diversified funds if the chosen stocks outperform. Control and customization. Individual stock investing provides control over sector weightings and the ability to customize portfolio holdings. Disadvantages. Higher risk. Investing in individual stocks carries higher risk compared to diversified funds. The performance of a few stocks can have a significant impact on portfolio returns. Research and analysis. Individual stock investing requires thorough research, analysis, and monitoring of company fundamentals, which can be time-consuming and challenging for individual investors. Lack of diversification. Investing in a few specific stocks within a sector exposes the portfolio to idiosyncratic risk if any of those stocks perform poorly. Each investment vehicle has its own trade-offs in terms of diversification, costs, active management, and flexibility. It's important to consider your investment goals, risk tolerance, time horizon, and level of involvement in managing your portfolio when selecting the most suitable investment vehicles for executing sector rotation strategies. Combining different investment vehicles can also provide a balanced approach that captures the advantages of each while mitigating their respective disadvantages.